In today's video, I am going to share a story about an individual and what he is presently going through in his journey for a high cash value whole life insurance product. But what he's going through, what he's gone through up to this point, and what we're looking at now really speaks to what a lot of people go through when it comes to whole life insurance. And really, the sad part about the story is you really have to ask a lot of questions in the beginning. You, the consumer, you have to ask the agent questions in order to ensure that the policy is truly set up in your best interest. So often what pops up when someone finally gets to the end of the road and they have that perfect policy that's set up for maximum cash value is this question: why isn't everyone shown this? Why isn't everyone shown high cash values right out of the gates? And the answer, there's a number of answers there, but often the answer is commission related. In short, as we go through this video, the only thing to keep in mind with respect to the commissions is when you're paying any dollar amount into a whole life insurance policy, the lower the upfront cash value, particularly the first year, the lower that cash value is, the higher the agent's commission is. So let's get on into it. And we're going to start with his email actually. So this was right after he had reached out via LinkedIn. And here we go. We've got, hi Steve, thanks again for connecting on LinkedIn. I've been searching for a good whole life policy for a few months now, not by choice, only because I feel like I'm not being given decent options. I was originally referred to New York Life by my estate attorney, but the agent seemed uninterested in showing me multiple options. He really just wanted to show me one, attached. Then I decided to get some quotes from Policy Genius and MassMutual from two agents, attached, to get their take on things. They were adamant they don't work for commission and really wanted the best deal for me. Sounds great, but when I asked why it takes 10 to 15 years of premiums to break even on cash available, they said that was the cost of doing business. And then he goes on to mention that he had found us on YouTube. And then the last sentence here reads, the MassMutual 1.75 million, that's the death benefit, seemed to make the most sense to me due to it having the highest cash value and death benefit around 63 years old, but I'm still not happy about the premiums and little cash available 10 to 15 years. Have you ever felt like that with a whole life insurance policy? You're told this is a great area to put money. You see these premiums being paid into the policy, but it takes a long time just to get your money back. When he mentions break even or cash available, he's referring to when he has more money in cash value than what he has paid into the policy. So you'll see, we're going to pull up the attachments he had sent, the actual email in his actual email. But what you'll see, or to illustrate what he's saying here, is if he has a premium, let's call it $25,000 per year, and he's paid that in for 10 years, that comes out to what? $250,000. If his cash value is $200,000, that means he has a $50,000 loss at that point in time, meaning he has not broken even yet on his policy. He has less than what he's paid in. If at the 10-year mark, he has $250,000 in cash value, and he's paid in $250,000, that means he has hit his break-even point. He has equal or greater value in cash value than what he's paid into the product. So let's take a look at exactly what he was shown, because this is really important and a lot of people go through this. So when it comes to options shown, specifically, he was shown these different options. One, New York Life. We know that his estate planner had referred him to a New York Life agent who had sent him a $1 million whole life insurance policy. This was a 20-pay product. What that means is that premiums are payable for 20 years. After 20 years, there's no premiums due at all. He's guaranteed to still have that $1 million death benefit in force, and his cash value continues to appreciate with no payments after 20 years. Some people are attracted to that. Then he was shown a MassMutual Whole Life 65 policy. What that is that payments, or what that Whole Life 65 means, I should say, is that payments are due up until the age of 65. Kind of like the 20-pay product, but in this case, funding it a little bit longer, up until age 65. Then he saw 2 traditional policies. This is referred to as a whole life 100 product, one for $1 million, and then one, this is a typo on my end, 1.75 million, which we are going to look at all 4. And we won't spend a lot of time on these policies, but what I'll add about this point is that they are all traditional whole life insurance products, meaning 100% of the money he is spending is going toward the insurance premium. Now, what a lot of people are not aware of is if you're going to pay any amount of money into a life insurance policy, you, the policyholder, can actually decide how much of your money goes toward premium and then toward riders that immediately show up in cash value. And we'll get to that as we progress through today's video. So his concern was what? 10 to 15 years to break even or to get his money back. And then when he asked why, meaning why does it take so long just to get my money back, he was told that is the cost of doing business. Is that the truth? Well, let's find out. And this is not saying the agent was lying at all. When we actually take policies and set them up for maximum cash value, there is a degree of knowledge that's required. It takes time to learn the stuff. Let's start with the New York Life policy you were shown. So we've got New York Life, good company, one of our 4 major mutual companies. They've always delivered. We've seen them always deliver when it comes to strong cash value. But I would not recommend this policy if he's interested in high cash value. Here's why. So we've got a lot of columns and such going on here, but he starts at age 38. Here we see age 39 in year 1. That's his age at the end of the first year. What we've got here, let me scroll down a little bit just to capture the top so you can see what's going on. What we've got here, guaranteed values and then non-guaranteed values on the right. So as we look at this, what's his premium? How much is he paying each year? Well, his out-of-pocket is $23,500, and you'll see that continue for 20 years and then stop. We'll scroll down so you can see that. But we've got the guaranteed cash value. Here's your cash surrender value, and then here's your guaranteed death benefit. So as he makes his premium payments, $23,500 per year, first year, what does his cash value look like? 0. Nothing to show for it at all. How about on the non-guaranteed side of the illustration? Nothing to show for it at all. $23,500 goes in, 0 in cash value. He does have a $1 million death benefit, which is great, but when we look at the actual cash value, is this something that you find attractive? Would you want to do it? Paying $23,500 and have nothing to show for it at all. Year 2, pays in $23,500 again. What do we see there? $63,20 in cash value, and that's on the non-guaranteed side of the illustration. $63,20. He continues to make his payments. By the 10th year, how much has he paid in? $23,500 times 10 is $235,000. On the non-guaranteed side of the illustration, which assumes dividends are paid every year at the company's current dividend interest rate, which is 5.8%, cash value is almost at $235,000, still has a loss, and his death benefit has increased a little bit to $1,064,000. However, if we look at the guarantees, he's paid in the same $235,000, and he's got just over $200,000. So $235,000. If we double that, what do we come up with? $470,000. Why I mentioned that is because this policy is payable for 20 years. So he's paid a total of $470,000 into this policy. Let's take a look here. So $23,500 times 20 is $470,000. Guaranteed cash value year 20, almost $500,000. So you do have a gain there after 20 years. Non-guaranteed $652,000. Death benefits also appreciated to almost $1.3. So starting to look better. As time passes, you will see a whole life insurance product look better and better. But those early years, those hurt, especially when you have a 0 right out of the gates. Takes more than 10 years to break even. A lot of business owners and real estate investors shy away from this because they don't have any cash value in the early years and they view it as a lost opportunity cost. The attraction to cash value life insurance when we hear about the core benefits, particularly around the cash value, is that it is a safe, liquid, tax-free area to position money. Tax-free if we don't trigger a taxable event. But looking at this, 20 years, to have a decent gain, would you do this? And his initial goal was death benefit. That's why his estate planner recommended whole life insurance. Would you do this if it was you? Or would you like to see some options? So if I say, would you like to do this? And the answers could be yes, no, or see more options, which box would you click? I would click see more options, please, just knowing what I know. So he did look for more options before he connected with us. First, he looked at a MassMutual Whole Life 65 product. Well, this and the other options, but let's look at this one first. And what this is, a Whole Life 65, is premiums are payable up until the age of 65. So in this particular case, what was shown to him was an option where the actual cash flow remained the same. So we've got $23,500 per year going in, starting at the age of 38. First year cash value, a little bit better than a zero, but not that much better. He's got just about 10% that shows for it. Death benefit, a little bit more than $1 million here. So again, what this agent did was solve for the same cash flow going in, $23,500 per year. And if we look at year 10, he's paid in the same $235,000. And based on the company's present dividend rate, he's got $210,000 in cash value. Again, long time to get his money back when we look at it here. Would you want that? From a cash value standpoint, from a death benefit standpoint, is it attraction? Is it attractive? Does it fit in with the rest of your planning? My answer here is probably not. For me, at least, that's not the case. Funds it in this example through the age of 65, which at that point, if you continue to pay premiums, here's his guaranteed cash value. And then here's his non-guaranteed cash value. About $1.1 million when we look at it. And what we can do is scroll back up. There's my total cash value year-end column. Death benefit has appreciated nicely as well, but he's got the same problem here. Okay, it's taking me a long time to get my money back. Let me continue to shop. So he moves on to another policy here, a Whole Life 100 product, $1 million death benefit, and look at the premium here. Instead of $23, almost $25,000, his actual premium is what? Just under 15 grand per year. Why is it so much less with this whole life insurance product compared to another product? Well, if you've ever shopped whole life insurance policies purely for death benefit, what you will find every single time is that the longer the premium paying period is, meaning the longer you can actually pay premiums into that policy, the lower the cost will be. This is, again, if we're death benefit focused. Everyone we work with is typically cash value focused, but I want to hit on this point, it's important. So, Whole Life 100. Remember the name of the last product? That was a Whole Life 65. Remember the New York Life product? That was a 20 pay. So a Whole Life 65 product means premiums are payable only up until the age of 65. So if I'm solely focused on death benefit, it will cost me a higher premium to get the same $1 million. Here, because the premium can be paid up until age 100, in order to get the same $1 million death benefit, it costs me less. A lower premium is due, but it's due for a longer period of time. And again, this is not the way I would recommend taking out a whole life policy. I'll show you that very, very soon as we progress through this. As we scroll down here though, what do we notice? 10 years, he's paid, call it $145,000, and his cash value is what? Not that attractive. When we look at this guy, 116 and change. So it's taking him way longer than 10 years just to break even and get his money back. We can look at the last option he was shown, which is the option he has gravitated toward just from the different scenarios he's been proposed. So here we've got, look at this, $1.75 million in death benefit. So this option, likely the pitch behind it, is let's keep your cash flow about the same, Mr. Client. So you're shown $23,500 in the first two examples. Here's $25,000. So it's slightly rounded up to $25K, $25,400. It's still a 100% premium policy because you've got zero in cash value in the first year. Not that attractive. But you've got a much, much higher death benefit. So typically the sales pitch here is, hey, you can get a much higher death benefit with the same out of pocket. And when you look at it long term, 10 years in, you've paid in $250, You've got just about 200,000. Eventually that cash value does get more attractive. But look how much more death benefit you have. Again, not attractive at all in my opinion. Let's make it attractive because I've talked a lot about this. So what we want to start with actually is the same Whole Life 100 product, but this would be pretty cool. So with a Whole Life 100 product or any life insurance product, you can actually design it. Remember when we mentioned you can choose where your money goes toward the insurance premium, which does not build cash value in the early years, or directly toward riders that build cash value immediately. So what was his concern? His questions: can I break even earlier? I want to see more of my money available, and can I see different options? He had asked that in the first email. He had asked his other agent that, but he mentioned the other agent did not want to show options. So yes, we showed him a variety of options. I'm going to pull those up next. Here's always where I would start. If this speaks to you, if you're in a similar position, maybe with different numbers, I would always look at the 4 major mutual companies, which are Mass Mutual, Guardian, New York Life, and Northwestern Mutual, have a track record of delivering the strongest cash values, cream of the crop. Product selection. What is his goals, or what are your goals here? Is it mainly death benefit? Is it mainly cash value? Or is it both? We'll show you how to get both here as well. Flexibility, very important here. So his cash flow with the different options is right around $25K per year. Some of them are a bit lower, some are $23,500, 2 of them. And the options I put together, just for the sake of making it a clean number, we made it $25,000 per year and a couple other options. What if I showed you options with $25K per year, but you could commit to a minimum premium, meaning you're not obligated to pay $25,000 per year, and then add more money to the policy at your discretion. Meaning, what if you could turn the policy into a flexible savings asset and add more money, less money based on your cash flow and how you like the product, instead of the insurance company sending you this large bill every year? Does that sound more attractive than what you've seen already? These are the questions I like to progress through and really ask myself. So when it comes to options, we showed him just that. Number 1, address his concerns around the cash value. And number 2, bring up points that others in his position have decided on, or things that others in his position have really liked to see. Hey, by the way, here's an option that a lot of people in a situation similar to yours have appreciated. Wanted to show this as well. This way you can see the different options up front. So let's take a look here. What we'll begin with is a Whole Life 100 product. We've got a rider attached here. We've got a handful of riders, but we've got the same $25,000 per year going in. So this is pretty cool. Cash flow is the same. First thing I want to note is the death benefit on this example is initially lower. We do not have it at $1 million. I will show you examples with $1 million. But cash flow, $25K per year going into the policy. If I'm you, here's the question I would ask. Of that $25,000, where is my money going? Because with a life insurance policy, your money can go toward one of 2 areas. The insurance premium, or toward other riders. Terminology, if you want specific terminology, is this guy a PUA rider? So premium dollars with a traditional whole life insurance product like this guy do not show up in cash value in the first year and sometimes the first and second year. Remember when we looked at the first several examples, how much did he have in cash value in that first year? Even when he's paying $25,000 in, 0. The second year, he had a small fraction of the next $25,000 payment, but it was next to nothing. So the premium piece often does not show up in cash value in the first year and sometimes the first and second year. As you continue to pay premiums, eventually it comes back. However, we can choose to add money toward this PUA, stands for Paid Up Additions Rider, which accelerates the cash value growth. So without going through all the mechanics in this particular illustration, here's what we got. There's your money column. Same policy here. This is the same product with the same company, same health rating. We're just redirecting where the money goes. $25K goes in. Here's his cash value right out of the gate. So almost $21,000. By year 6, he's very close to breaking even here. He's paid in $150. and he has 148 and change. The next year, he's positive. He's paid in 175. He has more than 175. So between years 6 and 7, I would actually not go with this option personally. Why we showed this option is first we wanted to keep things consistent with what he has been shown with respect to the product. The next option, we see the same company, but the product name has actually changed. So now we're looking at a high early cash value product. This guy is still a whole life insurance policy, but the premium dollars, we've got this at $2,500. But the last product, remember where we said the premium dollars do not show up in cash value in the first year, sometimes the first and second year. This product actually gives you 80% of the premium piece in cash value right out of the gates. And then we can plow money into that PUA rider as well. We do have term insurance riders attached too. This is really to prevent the policy from becoming what's referred to as a MEC. That's a modified endowment contract. It can result in taxes on the cash value. We've got other content on that. But point is, we've got a minimum expense policy, maximum cash value. So he pays in $25K. And look at this, right out of the gates. He's got about $23,000. Death benefit's a bit lower. It's at $600,000, but we designed it where the death benefit quickly increases. So it's a nice option for someone to see. If he said, hey, I really want that death benefit at $1 million day one, that's very important to me, there's two things we could do if this was the policy he wanted to go with. One, we could add more term insurance to this policy to raise the death benefit a little bit. Or two, we could take out a term policy, call it for another $400,000, which at his age would be very, very cheap. You could get it right around $500 per year, or even less at his age, and make it a 10-year term, because once we pass the 10th year, we've got well more than $1 million in death benefit and maximum cash value all the way through. Like, look at this, $25K per year for 10 years, and you're at $284 just by designing the policy differently. This is where the design is so important. We're looking at different products too. So as we continue on, this is one company here. We looked at Mass Mutual. Let's look at this option. You know what? Let's come back to this option. The other things I want to show here is we looked at more than one company. So here's Guardian, another one of our major mutual companies. Same thing from a design perspective, where we've got $25,000 going in, but here's my premium. 10% of the total desired payment. We can actually drop this one a little bit lower, but we made it 10% for this example just to keep it clean, meaning my total payment is $25K, and my minimum premium here is $2,500. Here's the cost of my term insurance rider initially, so I'm at $2,800 and change. That's my minimum commitment, and I can add more money to the policy. So in this example, what we aimed for was to fund the policy just for 10 years and maintain $1 million all the way through. So check this out. We've got $25K going in. Boop, 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 boop. Stop all together after 10 years. Cash value day one or year one, $20,000 and change, and the $1 million death benefit. Break-even point between years 5 and 6, meaning by year 5, I've paid in $125. I got very close to that. By year 6, I've paid in $150, and I have $152. The actual performance of policies is something we track as time passes, but we've got a cash-rich policy and the desired death benefit. He pays in nothing after the 10th year, and here's what we got. Death benefit stays at $1 million and eventually increases. Next example, you'll see this on an Excel spreadsheet side by side shortly. Same thing, $25K for 10 years. We designed this a little bit differently with a lower initial death benefit and much stronger cash value long term. So this way he can see, here's what it looks like if I go with Guardian, I pick a $1 million death benefit up front versus the same $25,000 per year, but I go with a lower death benefit in order to maximize the cash value. And I'm gonna put this side by side as well. And then what we looked at were just some additional options where showing what would it look like if I pay a higher dollar amount, more aggressive in the early years. So here's $50K for 5 years very cash rich initially, and then pay just the minimum premium, or just stop. Here's a MassMutual example. $100,000 per year for 5 years, and then nothing thereafter. A lot of people are attracted to these short funding scenarios because when we hear the word whole life insurance, how long do you think you have to pay into it? Your whole life. Not the case at all. Looking at this example, I've got $100K per year going in. This is actually a 10-pay product, which means you can pay into it for a maximum of 10 years. But here you go, $100K per year for 5 years. First year cash value, just about 90%. So we designed this for high cash value, but look at this. Death benefit, this was actually the minimum death benefit we could get based on the $100K per year payment, about $1.5 million initially. Then he pays in $100K per year. By year 4, check this out. He's paid in $400,000, and how much does he have in cash value? $400,000. So we've achieved an early break-even point. Then year 5, I've paid in $500, I've got $516, 0 thereafter. Cash value continues to grow quite nicely at that as well. And we've always aimed to keep the death benefit above $1 million in this example because you wanted to keep it above $1 million, or we're assuming that. So to simplify things, let's wrap this up. What we've got here are the different options side by side. On the left, I should say, starting on the bottom left-hand tab, we've got different samples with Guardian. And these are the different options we've put together with Guardian. What do we have? Option 1, $25K per year, but only for 10 years and maintaining the $1 million death benefit. So his initial goal was to have that $1 million death benefit. The premium with New York Life was about $25,000. It was $23,500. We can make this $23,500, no problem. I just rounded because this way after 10 years, he's got a clean $250 that went into it. But when we look at this, what do we see? $1 million maintained. I pay in a total of $250. I've got $281. And I've got a $1 million death benefit. I pay nothing in thereafter, and my cash value continues to appreciate over time. Then, option B, same out of pocket to you, $25K per year for 10 years. For the first 10 years, it's about the same. But then after the 10-year funding period, we actually exercised an option. It's called a reduced paid up option to eliminate the premium altogether, which results in 1, an initial death benefit drop. He might not like that, but it's a nice option to see. And look at the cash value difference. You paid the same dollar amount in here, but what's your difference in cash value? It's beginning to become a wide gap there. You will see greater value here and a greater long-term death benefit when we scroll down. In fact, let's do that. If we look at age 70, there you go. There's about a $30,000 difference in cash value and a $40,000 difference in death benefit. So really the question is here, and why we like to show these different options is, do you want more death benefit up front or more death benefit long term? Maybe he goes with this and adds a 10 or 20-year term. There's different strategies you can do if you're very focused on death benefit. And then here's more cash value focused policies. They're the same products, just designed differently. This is pretty interesting. Where first, we've got $50K for 5 years, so the $250K in over 5 years. And then what we did was pay just the minimum premium of $5,000 through year 20. So we get to a total of $325 in this example. This example allows him to maintain a death benefit always greater than $1 million. That's why we kept paying that premium. If he said, hey, I've got a lump sum of cash, I just like the idea of moving it into the policy as quickly as I can, $50K for 5 years and then nothing thereafter, break even year 5, and I don't have to pay another penny into this policy from that point forward. That's correct. So not a penny goes in. We executed, again, that RPU, that reduced paid up option in year 8, which did drop the death benefit. It eliminated the premium altogether, so he can't pay anything into the policy even if he wanted to. But boy, does that cash value look good over time. So that was Guardian. Let's look at MassMutual. We already progressed through these illustrations. As we look at this, you've got that whole life 100 on the left, Then you've got the high early cash value, 500K total, meaning 25K per year for 20 years, and then this option. This actually really caught his attention, and he asked a specific question here on the 100K for 5 years option, because that, when you compare it to the other options, gives you significantly more cash value long-term. Even up front, it's fantastic. More death benefit, only pay into it for 5 years and then I'm done. I can keep going if I want to, but a lot of people like the idea of being done after a short period of time. His question was this: if I go with this option, Steve, and I can pay up to $100,000 per year. So 100K is my max, got that. Money can be directed toward the insurance premium or toward that PUA rider. Do I have to pay this? Meaning, can I take the policy out, just start with $10,000 and then add more at my discretion? And my answer was yes, depending on the company. So here with MassMutual, he cannot easily add money at discretion. Really, MassMutual works very, very well if he wants to make one-time per year payment adjustments. So maybe in the first year, let's say he started off with 50K, and then he wanted to add more money. You have to wait until the next year to do so, or he could go up to $100,000 without any medical underwriting. And we can bounce it up and down year in and year out. If he said, okay, I don't want that. I want more flexibility. I want to be able to just commit to a $10,000 premium and then throw more money into the policy at my discretion. Can I do that? The answer is yes, you can do that with Guardian. So Guardian has that PUA flexibility where it can commit to the minimum only and then just pour excess funds into PUAs anytime that he wants. Very flexible there. And he can set a policy up in the same manner. But that's as we continue to progress through different options. How do you make it as flexible as possible so we can not just have a boring insurance policy that he has to pay a bill every single year, but turn it into a flexible savings asset? So this one was a ton of fun. I hope it demonstrated something similar to what you've seen before or experienced when it comes to whole life insurance, which is often, here's a basic policy. I wonder, why would I do it? And then I start to see the policy gradually turn into a high cash value policy and think, why would everyone not do this? Or at least, why is everyone not shown this? Because not only do I have the death benefit I wanted, but I've got high cash value as well. So I hope you enjoyed it. If you did, please hit the like button, subscribe for more. Feel free to leave any comments below. I do check them out. And I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.